Hey, welcome back. I'm Kate Presto, founder of KISS Accounting, and this is Keeping It Simple. Today we're going to talk about tax reform and how it's impacting small businesses. By small businesses, I mean your LLCs, your sole proprietors, partnerships, and S Corps. So, the Tax Cuts and Jobs Act, aka tax reform, it was the largest tax overhaul since 1986. There's a lot of details to it. It's a huge law. And so we're only going to cover the most important changes for small businesses today. And we're covering what changes happened at the federal level. If you live in a state that charges a state income tax, you're going to need to talk to your CPA there about how it's going to impact you. They may have adopted all of the changes, none of the changes, or somewhere in between. So before we get started, I want to remind you to think about taxes like a big formula. So the tax reform law changed parts of that formula, but primarily it's the same. The foundation is still there. So when you're thinking about these tax reform, just know it's just little tweaks here and there. And you're probably wondering, okay, so how is this going to impact me? Cut to the chase. Another thing to keep in mind is that small businesses, they don't pay taxes themselves. What they do is the income passes to the owners, and the owners pay taxes on the business's income. So the business doesn't pay taxes, the owners do in the year it's earned. So how tax reform is going to impact you is intertwined with your personal tax situation. And if you're interested, if you don't know a lot about how tax reform impacted your personal situation, I discussed the top changes in a prior video, and I've put the link below. So let's dive into these big tax law changes. So first off, we're going to talk about meals and entertainment. When the law first came out, from how it was written, I thought that we weren't going to be able to deduct meals at all, or entertainment, which really stinks. However, late in the year, the IRS clarified it and said, yes, we can still deduct meals at the same 50% rate as always, but entertainment is no longer deductible. So what does that mean? Here's an example. If you go golfing with a customer or a vendor, the green fees would be considered entertainment, and those aren't deductible. But if you go out for lunch afterwards, that's a meal, and that's deductible at 50%. So now, even more so than before, it's critical to keep your receipts and take notes, proper documentation, to make sure that you're being able to pick up 50% of the meal portion. The bill needs to be split between entertainment and food. Otherwise, it would be all considered entertainment. But hey, at least you still get to keep meals. And Christmas parties, for some odd reason, they fall under a different category like office supplies or something like that. And those are still 100% deductible, even though they are quite fun. Next change is going to be depreciation. So if you're not super familiar with depreciation, I'll explain the concept a little bit. So if you buy something really expensive and you expect to use it over multiple years, usually you wouldn't take the expense and the tax deduction for it all in that first year. You would spread it out over the years. Well, there's a thing that's not new, but they definitely increased it a lot, and it's called bonus depreciation. So what this allows you to do is take 100% of that expense in the first year that you buy it and put it in service. So even if you financed it and you haven't paid it and the cash hasn't gone out the door, you can still take that expense all in the first year. And if you're familiar with the time value of money principle, this is good because you're saving money at the upfront and kind of just taking the expense up front. Your money's worth more now. You get to keep more in your pocket now. So that's a great thing. And there's other types of depreciation that also changed. So there's another one that we call Section 179. That's literally what we call it. And it's a lot higher now too, but with bonus depreciation, it's not as relevant because you can take a lot of bonus depreciation. I mean, there's caps on both of them, but you got to be really big to get to those. And then I will note that, again, you want to consider the state tax implications. So I'm in Connecticut, and bonus depreciation the extra bonus depreciation is not allowed in Connecticut. So they add it back into your income. Whereas for Section 179 assets, they only add back in 75% of it. Now, you get the rest of those deductions over the next several years, but again, time value of money, it's better to get it up front, and then it also for tax planning and estimated tax payment, it can cause a bit of a headache. So you might want to be running multiple scenarios to see what really optimizes your tax situation. And I would highly recommend that you speak to a CPA if you're going to do this, because it gets complex fast. Next, let's talk about net operating losses. So every business has a bad year, and that's normal. So the IRS is a bit forgiving in that they will let you take that loss and deduct it. Well, previously they let you deduct it against prior year taxes. So you could go back 2 years and recoup your taxes paid, and then you could carry the rest forward for 20 years. Now you can't go backwards and recoup the 2 prior years, but you can take it forward indefinitely. So if you have a really bad year and then you're only kind of just like squeaking by a little bit, then it doesn't matter. I mean, you're going to keep that deduction and be able to take it whenever you need it, however long that takes. So those are really exciting changes, but I've saved the best for last, and that would be Section 199A. So why I'm so excited about this deduction is because it is a brand new deduction, and it is 20% off of your net income. 20% off. So 20% of your income is not taxed, which is amazing. It's a complicated rule. So it's also called qualified business income, QBI. And I need to stress the qualified part. Certain trades and businesses, they will max out of the deduction. If you make a whole lot of money, you could max out at the deduction. If you don't have employees, or if you only have dependent contractors, you could not be able to pick it up because there's just a lot of rules around those 3 areas and more. It's a complicated deduction, but the quick and dirty explanation is 20% of your income is not taxed. So I hope you're excited about all these changes, especially QBI like I am. And I do think that these are going to lower your business's tax burden. So that's really exciting. And you got to run the numbers though, like I said. You got to run the numbers to see how they're going to impact you. But I do expect that in general, you're going to be paying less taxes. 20% off your net income, as long as you don't qualify out of it. So, quick recap. Meals are deductible at 50%. Entertainment is no longer deductible. You can expense big purchases 100% in the year purchased and put in service. Net operating losses, they can't be carried back, but they can be carried forward indefinitely. And the new Section 199A QBI deduction is a 20% haircut off your business net income for tax purposes. So these are just the tip of the iceberg when it comes to discussing tax reform for small businesses. And if you have more questions, I'd be happy to jump on a virtual chat with you and discuss your situation. Like I said, it literally is different for everybody, and you got to run the numbers in order to know what the impact is. But the good news is that we now have a lot more clarity about this new law, and it's the perfect time to do some tax planning. So I hope you enjoyed this video and found it helpful. If so, please send it off to a friend and subscribe for my newsletter. I send out a bi-weekly email with fresh content like this, and you'll also get a lot of other helpful tips for small businesses. So thank you, and I'll see you again soon.